Okay, we have started our recording and we are ready to get started. Um, Good evening and welcome to this week's episode of Midweek Money Matters. Today we're talking about common investment strategies. We are recording today's session, so I will ask you to enter any questions that you have throughout today's presentation in the chat box, or at the end, I will stop the recording and we will unmute everyone and give you the opportunity to ask your questions at the end. So without further ado, my name is Katrina Boyer, and it is my pleasure to get started with you tonight. So we're talking about investment strategies, but before we kind of tackle what those are, we need to have an understanding of what they are. So we'll talk, we'll kind of outline what that is. And then we're going to talk about the things that we need to consider before we jump headlong into a strategy that may not be good for us. And then we're going to talk about the four main strategies. There are nearly as many strategies as there are people who come up with them. So it's important that we understand that. And I chose the top four that have been pretty commonly accepted in the investing world. And then we'll talk about, some things that we want to remember as we start to go down that, as we start to choose our strategies. And we'll talk about what it looks like when we change strategies. So an investment strategy will help an investor to make decisions that are based on their specific goals. But you also have to consider your risk tolerance and your future needs. So the four categories that we're going to be talking about today are value investing, growth investing, momentum investing, and finally, dollar cost average investing. But, just to go back to that strategy, as you start to think about what strategy may be good for you, you need to consider that risk tolerance and what time frame that you have, because you're going to see throughout today's session that some of these investment strategies actually require a longer period of time. So we have to make sure that we keep that in mind as we start to proceed. But before we put the cart before the horse, I think it's important that we take into consideration our age. Am I planning to retire in, 3 to 5 years? If that's the case, then some of these investment strategies may not be good for me. I need to make sure that I consider my goals. When am I looking to retire? When am I looking to take advantage of my investments? And then the other thing is, what is my risk tolerance? A risk tolerance is the amount of risk that you're willing to accept within that specific investment or that financial market. If I've got a long time before I retire, I just turned 50 last year, and I anticipate that I'm probably going to be still working for another 15 to 20 years. So my risk tolerance may be bigger. I may be willing to accept more risk because I have longer to go before I retire. As I start to get closer to retirement and I'm looking at 10 years or 5 years, my risk tolerance is going to change. I'm not going to be so willing to take on that risk in order to get a bigger return on my investment, because with return on investment, with the higher return comes a higher risk. So that's something that we have to make sure that we really understand. So let's talk about value investors. Value investors are people who are shopping for a bargain. We all like to buy things on sale, right? So that's something that we have to take into that we want to look at for value investors. bargain investors are actually shopping for stock that they believe is valued lower than the stock is actually worth. So it's kind of like buying a dress on a 50% discount. But you have to keep in mind that with value investing, this has to be long term. You have to be able to give that investment the time it needs to reach its full potential. Now, there was an article in the Wall Street Journal in 2014 where the author said that over the decade that ended in December 31st of 2014, value funds returned an average of 6.7% every year. But typical investors who used that strategy only earned about 5.5%. And that would be because they cashed out that investment before they had allowed the stock to take its full run. So we need to make sure that we keep that the lesson that we learned on this is that if we want to make the value investment work, we have to be willing to play that long-term game. Warren Buffett was actually a great example of a value investor, and he was highly committed to that long term. In fact, he went on to say that he had made a pretty large investment in the airline industry. And he said right off the bat that, the first century that airlines were in business was bad for them. But they got the bad out of the way, and he believed at that point that the airline industry was going to take off. And the reality was he made a lot of money off of that. So when we're a value investor, we make our choices based on decades worth of trends. It's not something that we want to look at. So if we're looking for a value, we're not going to look at just the last year. We need to make sure that we go back and look at that long term. For investors who don't have the time to spend researching details of a company, one thing they always look at is the price earnings ratio. Now, that is a single number that you get by dividing the stock's current share price by the earnings per share. And you can find the earnings per share and the current stock price by looking on any of the financial websites. You can look at CNBC, Yahoo Finance. You can look directly on like the stock exchange websites. That's where you can find what those numbers are so that you can come to that price per earnings. So you want to keep in mind that the lower price earnings ratio tells you that you're paying less per dollar than the current earnings. So that's basically telling you what your discount is. But again, you have to make sure that you're in the value investing strategy, and it has to be for the long term. If you don't have the time, then you may actually end up seeing a loss. So you want to make sure that you understand that strategy very clearly. So the next strategy that we're going to talk about are growth investors. So growth investors are looking at what they believe is going to be the next big trend. And they're looking for a company that they're expecting to have great big potential. But you have to take a look at some of the industry prospects. When I was researching growth investors, one of the things that I actually read about was the company GoPro. And so when it initially took off, it was the only product in that industry. So a GoPro, if you're not familiar with it, is a camera that allows you to record. You can wear it on your head or your forehead, or you can put it on your bike as you're riding, and it allows you to record when you're doing things. It's basically a camera. So GoPro was huge when it first hit, and then cell phone companies, cell phone manufacturers have really upped their game, and now we've got these great cameras on our cell phones. And so what the reality has happened is that GoPro hasn't excelled in the industry like a lot of investors thought it would. So a growth investor actually considers the prospects of the industry that the stock is thriving in. So another example might be electric vehicles. There has to be proof that the company is going to do well, and that there's actually going to be a market for it. Many years ago, I actually rode in a vehicle that was 100% electric, and I thought the guy was completely, out of his mind, if I can be completely frank. He insisted that everybody should be investing in this market, and the reality is that as we see more and more vehicles that are running on electricity, he may have been onto something. So he would have been considered a growth investor. So I think that one thing that you have to be prepared for with growth investing is that growth investors don't expect to actually earn dividends. If you participated in our session on stocks, we talked about the fact that dividends are basically your share of the profits that a company realizes. A lot of times companies will split the profits and they'll say, okay, we're going to reinvest X amount, but this other amount is going to be paid out in dividends to our stockholders. Companies that are focused on growth don't pay dividends. So one thing that you have to remember, if you're a growth investor, if that's your strategy, you need to realize that any profits the company sees are going to be reinvested in order to continue to grow that product. So I think that's something that we all need to be aware of. If you're looking for something that's going to pay a dividend, growth investing may not be for you. Because growth investors and companies are looking for growth in the company no matter what the cost. So that's something that we have to keep in mind. Let's talk about momentum investors. Momentum investors are the ones where the winners keep winning and the losers keep losing. They are using a data-driven approach. So they're looking for patterns that help them to understand when a good time to buy and when a good time to sell is. Momentum investors require a lot of research and a lot of watching, because you have to be prepared to buy and sell very, very quickly at a moment's notice. And so there's this other concept that some momentum investors use, and I don't want to spend a lot of time talking about this, but I do think it's important to explain. So short selling is this concept where an investor actually borrows a stock from a broker. They sell the stock and then they wait until the price, because they think that the price is going to go down. Okay. If the stock goes down once the investor has sold the stock, they buy it back at the lower price, and then they pay off the lender with this big profit. Now, if the price of the stock, if the price of the stock sells for, let's say the investor bought 5 stock and he sold it for $500, but he bought it back at the lower price. So let's say he sold it at $400. He's going to make $100 per share profit. But the thing that you have to remember is that if the price doesn't drop like you think it's going to, the potential for the loss is basically the sky's the limit, because if the stock price goes way up, instead of repaying the lender at $500 a share, they may have to repay the lender at $700 a share or $800 a share. And if that's the case, they're actually realize a $500 or $600 loss rather than, a $250 gain. So momentum investors who do what's called short selling are taking on a huge risk. Now, if you're the type of person who's willing to do that, going ahead and doing the research on how to do that sort of process, is something that you can certainly do. But you need to absolutely be aware that really the potential for loss is one of those things that literally the sky is the limit. If I buy stock for $200, the most I can lose at this point is $200 because that's what I've invested. If someone who's short selling buys a stock, and when they have to repay that loan, if that stock is selling for much higher than they originally bought it for, that's the amount that they're going to lose. So keep that in mind if you are an investor who is looking for sort of that nibble on your nails kind of that sort of exciting type of investing. Now, the fourth type of investment that I want to talk about is one that many people talk about, and that is the dollar cost average investors. So basically, with dollar cost averaging, you are investing the same set defined amount every month or every pay period. So you designate, let's say $50 every 2 weeks is going to go into your investment account to be invested in however way you want it to invest, whether that's stocks, bonds, mutual funds, whatever. The great thing about dollar cost averaging is that you are not having to constantly watch the market to decide when you want to buy and sell, because you're consistently buying through the ups and the downs and leaving your investments where they lay. That's really great for long-term growth. It may not be the best strategy if you are looking to invest a big lump sum investment, because particularly if the market is doing very well, you may be buying stock at a much higher price than at another time. So keep that in mind if you have a lump sum a lump sum investment. However, dollar cost investors over the long term are taking advantage when that market is down, because they're still investing that $50. That $50 gives them more stock when the market's down. So that's where you're sort of getting that on sale pricing, but you're consistently investing even when the market's up. So you may not be getting as many stocks or shares in the investment, but you're still being consistent. And that goes a really long way in helping to grow those investments that you have. So we've talked about the 4 different types of investment strategies, and it's time for us to kind of stop to think about what kind of investor are we? Are we one, the nice calm, where we're just going to do the dollar cost averaging, and we're going to be consistent, and we're going to do what we need to do? Or are we going to take a kind of a fast and furious approach, where we're going to watch the market and decide when is the best time to buy or sell? Or are we going to spend time researching for companies that that we think are going to take off, or that we think they're about to hit their stride and excel and do really well? The thing that we have to keep in mind is, it's okay if we start with one strategy and we move to another, but we don't want to be where we're jumping from one strategy to another, because if we do that too frequently, we'll end up realizing we can realize loss more than we would if we would just sit tight with that specific strategy. So we want to make sure that we keep that in mind. Um, Diversification is another thing that we really need to make sure that we understand and we keep track of. We don't want to put all of our eggs into, that one basket for that one company that we think is going to, experience this great big growth. Because what happens if that one option doesn't? If we haven't diversified, that means spreading our investments over different companies and different, different ways, whether it's stocks, mutual funds, bonds. If we have it all in one, and there's a big loss, we may lose significant wealth. So that's important that we consider. And then another thing that we need to consider with our investment style is, are we using an advisor who's going to listen to us and help us to reach those goals, help us to use that specific investment strategy? Or are we going to go with something that's less hands-on, maybe a robo-advisor that is all electronic? Or are we going to use a broker-dealer who is going to simply do what we tell them to do? If you'll recall, a broker-dealer is that person who buys and sells investments on our behalf. If you feel that you have the time and the energy and the knowledge, it would be very cool, I think, to use some of that in your favorite strategy, and be able to have that. But again, we go back to that diversification, and we want to make sure that we're covered on all of those ends. Now, if you have been on any of our other presentations, you know that these 30-minute sessions tend to kind of go by very quickly, but I do like to provide everyone with other resources. So I always mention my office, the Pennsylvania Department of Banking and Securities. We do have a website, dobs.pa.gov. We have a list of publications that are available for download at no cost. You can also go to the Investor Protection Trust at investorprotection.org. They have an amazing amount of publications. They have some fairly new ones that have just come out. Actually, they have some new ones that have just come out since the pandemic has hit, that really talk about investing from the perspective of, a lot of them are based on where you are in your career. If you're just getting started, these are some things, some strategies and some things that you would want to understand. And then, as you get closer to retirement, there's some different publications. And then there's When I'm 65 is a documentary that has a website, wi65.org, that has a lot of really great information. They have some really short videos that talk about different, where we are as far as age goes, and different investment strategies that we may want to take. So they have some really great resources as well. Our consumer services staff at the Department of Banking and Securities are available during regular business hours, Monday through Friday, 8 to 5. You can reach them by calling 800 PA Banks. And what's really fantastic about our consumer services office is that we have 4 trained professionals that are available to answer your calls. So there are no menu options. You don't have to push 1 for this or 2 for that. It's not going to take you 10 minutes to get to a human. As long as someone is available, they'll answer your calls. Now, if they happen to all be on the phone at the same time, there will be an answering machine that will take a message, and someone will typically return your call either that business day or within 24 business hours. So that call is free, and all of the services that we offer, whether it's helping you to resolve a complaint about an entity that we license, whether it's helping you to verify your investment professional or the investment that you're considering investing in, our office can help you find the resources and information that you need. So this concludes today's presentation of Midweek Money Matters. I hope that you have found this information to be helpful and useful. I am going to stop the recording now. I'll unmute you so that if you want to go live and ask a question, you may do that. Let me stop the recording before we do that.